Well, we meet again, and it's time for your Twin Cities real estate market update. I'm your agent, Joe Carmack, and we got a lot to talk about this month. So I'm gonna hit you with, first of all, prices, exactly how prices are going up and or down. We're gonna talk about what to expect if you're buying and selling in today's current market. And then last and most importantly, I'm gonna hit you with kind of my forecast for the future, both for interest rates and home prices. And I'm gonna tease you with this graph up front. I don't normally do that, but it's genuinely so important that if you don't understand this, you're gonna completely screw up your future, I think, as far as what to expect. So let's start with sale prices, and we're gonna look out. This is the zoomed out big picture right here, and you can see right in here, this was that big giant market crash that we saw. Why don't I go ahead and zoom in on that for you? And this is all we have. So if you've been following me, you've seen that January through April, we were at 365. That's that little plateau there. We then dropped down a whopping $1,000 to 364. That's the median sale price around the Twin Cities. And in July, we saw that number come back up almost to where we were. So we're a whopping $200 down with that rolling averaged median number. This is the best way to look at kind of what's happening in a broader scope, but we will also zoom in for you with that monthly. Oops, let me clear that off for you. So a couple things I'll point out here. This red line there is where we were at for July, 375,000. That's actually the exact same place that we were right in here. That was also July of last year. So we're exactly the exact same number for that monthly number from this July to last. This was June, and we had a higher June this month than we did last year. So overall, our prices are not down. The market hasn't crashed. We're not seeing any major shifts, and I actually thought we would have. I mean, I thought we'd be lower on that sale price number. We are expecting things that they could taper a little bit. And earlier in the year, especially when we're looking at this sort of thing, we were expecting that we would see our prices this year maybe doing this. Instead, we are seeing this now. This is the average sale price versus the median. Now, I don't know, maybe somebody smarter than me can answer if there's a value of looking at the median versus the average numbers. I think median's more reliable because it's what most people will experience. Average takes into effect some of the more high and low extremes. But in any case, that same number, if we're looking at the averages from July, you can see here we're at 451, and this is July last year. On the other end of that red line. So we're up about $17,000 year over year since last July. However, with the average number, you can see there, our June had spiked there. The average number is down. Again, I don't know that there's a lot of benefit to the median versus the average, but it is just interesting to note that prices are not down like we kind of expected they would. Why are we seeing those things happen? Now, here's where we're at for interest rates. We're right around 7%, as you can see right there. There's no major changes happening. Here's my speculation, kind of educated guess as to why we're seeing what we're seeing in the market with prices going up. And really, I think it's because let's start on the left side over here. This is the last 12 months going back to September of last year, essentially. It was at that point we saw these numbers just jump as far as what the interest rates were, from 5% down here to now we're up in the 7s. And so with that happening, we then saw a whole lot of volatility, right? And we're seeing it do this number. With that volatility, people were really uncertain. They'd get pre-approved for 6%, and then all of a sudden they find a property they want to buy, and then it's 7% interest rates, and their payment went up $300, right? That's incredibly hard, especially emotionally. I mean, buying is a very emotional process. So then when all of a sudden people are doing that, they're like, forget this, I'm not gonna make a move, right? As things even out, and as kind of that pain point of, well, we really got our heart set on buying, we really wanted to buy, or we really don't like where we're at, we don't like the rental, we need to get out of there, or we've outgrown the house, whatever the situation is, the motivation, I think, has been amplified over time. So people that had been waiting for that volatility in the interest rates to go down, that has subsided some, and those that just had that itch to move have basically accepted that rates aren't going anywhere anytime soon, I think is my guess. Because it's been so long, right? Maybe they renewed their lease, they sent it out for another year. Rates are still at where they're at. No one's forecasting them to come down significantly anytime soon. So as a result, I think people then are getting back into the market. They're making the move anyways. That's increasing our demand a little bit. And so that's why we're seeing prices pushing up, and our activity isn't shifting as much as we thought it would be. So From when I updated the slide last time, we're up 0.15%, which isn't really a significant leap. But as you can see here, we're just not seeing nearly as much volatility. Usually what you get quoted with your pre-approval is pretty similar to what you're gonna be actually buying your house at. I would just caution you to keep in mind that that rate could go up a touch from the time you get pre-approved to the time you find a property. Let this serve as your annual reminder that if you are buying and selling a home, seasonality doesn't really matter because it helps you on one side but it hurts you on the other, or vice versa. If you're just buying a house, winter is absolutely my favorite time, and this is why right here. So this is our peaks of the summer, okay? I mean, COVID didn't really count because that year was just wonky, but every summer we see sale prices peak and then they come down every winter. So this is your average sale price, and then these are those winter months down here. So what do you think is gonna happen this year as well? We're going to see this number tapering down like that. Who knows how far it'll go, but generally it's always, there's less demand in the winter. Listings that were on the market that didn't sell are still left out there. Sellers become incredibly motivated, and then the buyers stop more quickly, right? You can just decide to stop buying much more quickly and abruptly than the listings. Sellers will just leave them out there and let's just give them a few more weeks and see if we can get the home sold. So those sellers become incredibly motivated. Your competition as far as buying drops back. That causes sale prices to go down, and supply and demand is extremely important these days. That's going back to that forecast that I'm gonna give you at the end. You have to understand supply and demand. All right, let's go to month supply of inventory. I normally start you with this one. We're putting it in the middle because there's just not that much change. This is really indicative of what it's going to feel like when you're buying or selling right now. On this graph, the lower you are, the more of a seller's market you're in, the higher, the more of a buyer's market we're in. So just a quick refresher for anybody new to the channel. We've been seeing the market shift just like this over about the last year, year and a half, 2 years even, and we're seeing this to be trending out of becoming such an extreme seller's market to being towards a balanced market. The red line here is what we would have to be median, middle of the road balanced market, where it's considered equally fair for buyers and sellers, where that supply and demand is balanced. We're not even remotely close to that. So we're at 1.8. For those that are nerdy like me and track these numbers, that did say 1.7 in June, and you can see there's a +0. The reason is they apparently updated the numbers. I still don't know why they do it, but they're now calling June 1.8, and then July also at 1.8. So we didn't see any change in that. Overall, just general thoughts on this shift in the market. Compare it to something like this, something like this, something like this. What's the main thing that you're gonna notice? It's a lot more slow and gradual of a shift. They're ratcheting up interest rates to get it to shift. However, inflation has just been really persistent, and I think that's kind of slowing things down. With that comes days on market. Now, this is the one that's been, I don't know, infuriating, curious, completely unpredictable. This is our median days on market, and I'm showing you the month-to-month changes. This isn't the rolling average here. So let's rewind. Things were selling extremely quickly. I think 10 days or something was the lowest that we hit down here. And then this year we saw this huge spike, right? And we're thinking, cool, maybe if our days on market goes up, that could indicate that we're seeing a big shift. Earlier this year, we're like, sweet, let's see that top line go up and hit something like so, right? And then all of a sudden everything crashed down, and we didn't anticipate this to be the normal peak of days on market. Days on market going up during the winter, and it's coming down, of course, during the summer months. Back to my previous conversation, seasonality, buying is a whole lot easier in the winter. So we saw that. We should have seen a normal valley like normal. However, now I don't know what to expect. I mean, I have no idea what to predict. This number does always go up. Since we can see, we're at the low point right here. So we know that things are going to be trending upwards, but where are they gonna go? We have no idea, genuinely no idea. If this number goes like this, and let's assume we're trending upwards, then maybe we're gonna see these numbers going up to something like this, and then down for next year and doing this number. That would be a pretty logical reason, logical prediction for what's gonna happen, but just truly we don't know. First of all, we have prices right now that are up here, okay? They're high. What are we expecting for the next few years? Well, no one's expecting that things are going to drop anytime soon. However, with the presidential election and just where inflation's at, we do anticipate that they will start to go down at some point, okay? Right now, you know, we're at something like 7%. Where are we going to go? I have no idea. I mean, it's pure speculation. Anybody that says otherwise is totally off their rocker. But 5%? I mean, maybe something like that. That's a good guess. That's kind of what I'm hearing, something like that. I would anticipate not within a year. I would say maybe 2 years or so from now. That might be a good target. Could be 1, could be 3. We don't know. And then let's talk about home prices. So home prices are high, kind of like you've seen. They've been going up, and we've kind of tapered, and kind of got some indication they might go down, then they didn't. But here's what I can tell you. When we see interest rates go down, that's going to have all these people that have been sitting on the sidelines. We've got the number of closings is down like 30% in the metro, because it's a whole bunch of people that are just pushing pause. They're saying, ooh, rates are really high, I don't want to have that payment. They're pushing pause even though they would want to be out buying a house. And as a result, that's curbed demand. Well, what happens when all of a sudden those rates go down? That's going to spike demand, because all of a sudden, as those go down, people are going to go, okay, I can deal with 6.5%. Somebody else is going to say, I'm going to wait till it gets to 6. As soon as we hit 6, then they're going to be in the market, right? And it's going to be the snowball effect of as rates go down, I guarantee demand will go up, and as demand goes up, prices will go up. So what we're seeing right now in the market is a whole lot of this. People are waiting until they see these rates that are in here, right? And they're like, all right, when I get to this point, that's when I'm gonna make a move. But the problem is they're still expecting that they're going to get this price point, right? They're hoping that prices are gonna do that. They're not. Let's face it, everybody's hoping. Let me back this up. Everybody's hoping that our prices are going to go down like this, and rates are going to go down like this, and then they're going to buy over here when prices are low and rates are low and everything's great. That's not happen. That's not economics, right? So just keep in mind, you can plan for yourself whatever is right for you in the future, but just know that as that happens, demand will dictate that prices have to go up, pretty much in step with rates. So what do you do? What's the solution? And there's 2 scenarios. Let me paint the picture. You can decide which one you like. I don't know. But if we go back to here and prices go up, if you bought a house, let's say, let me get a different color here for us. All right, let's say you bought a house right here. Okay, that's 2 months from now, 6 months from now, maybe by this winter, right? All right, you know that you are at that time locking in a rate of, we'll call it 7%, and you're locking in your home price. Median price is at $365. So let's say you're buying right now, $365. I'll be fair and say, all right, over time, your mortgage balance is gonna go down as you pay it off. Your interest rate will stay the same, okay? That doesn't ever change. You're locked into that interest rate, and you're locked into that mortgage amount. But don't forget, prices metro-wide are still gonna be doing whatever they're gonna be doing. Your mortgage balance is going down, and the value of your home is doing just like we said. It's going up. So then let's fast forward, I don't know, 5 years down the road maybe, and then all of a sudden you're going to have this much in equity, okay? Because equity is what you owe against the property versus what your home is worth, right? What it would resale for. That's one scenario. But you're saying, all right, cool, I like the price, but I don't like the rate. Well, what pretty much everybody's doing is they're not buying down the interest rate now, because you'd just be wasting money. Buying it down meaning you can pay a fee to get this rate dropped down a little bit lower. Don't do that because it'll be a waste of money. But what you're going to do is you're going to wait until we get out a little ways. And then maybe let's say, all right, somewhere in here, maybe it's 5%, right? You're then going to refinance your home right here. What is that going to do? It's not really going to change your mortgage balance too much. However, you should have some equity built up in your home. Maybe it'll be a lot, maybe it'll be a little bit, we don't know. Maybe there won't be any. But at least you can then take that rate and let me switch my colors. So then you're going to refinance right here, and all of a sudden that's going to drop your rate down to wherever your rates are, and then you'll be locked in at that rate. I don't know what that'll be, 6%, 5%, maybe 4%, doubt it. But so then what that scenario creates for you right here is you've got the lower sale price and you've got a lower interest rate. And very likely, let's say you bought a house with 5% down, maybe you've got some equity and you can get to 20% down and you can roll off PMI. So now all of a sudden you're saving a few $100, a couple $100 maybe a month on your PMI, mortgage insurance, and you've got an interest rate that's 1 or 2% lower. So then all of a sudden your payment's going to drop dramatically, right? Let's say you bought a house, let's say you want to wait, okay? And that's a perfectly fine scenario. I'm not gonna push anyone to move. So then you buy right here. You are then locked into this payment on this property, okay, when prices are here. There's a very good chance that you're gonna be then having more competition. So in fact, you're buying above what that market rate would be for the home. So you're overpaying for the property when there's more demand. But the benefit is that you're locking that in at a lower interest rate, right? So we like that. Here's the problem though. You're then locked into this price on a home that's worth this much. So, and this is probably not a great example, but so then over time, you're gonna have to take some time to burn through for the value of the property to rise to meet the price that you paid for it. So you're actually gonna be in negative equity position for a length of time. Could be 1 year, 6, 2, 3, I don't know how many years, but that will be at that point, and you will have locked in that rate. So then your rate's not going to change. I'm really trying to get fancy with the colors. Sorry, here we go. So you'll have your rate locked in low, but it's gonna be based off of a principal balance that's exponentially higher. So then if you actually put these numbers into a mortgage calculator, let's say you paid another $50,000 for the same home, but you got it at a lower interest rate, your payments are gonna be pretty much the same. And the problem is you're not gonna be able to refinance to get any better of a position, right? You're also not going to have a lot of equity getting built up. So you'll have missed this whole rise in your home value, so you won't have the equity coming into it, and you're gonna be locked into this payment. The payment might be a touch lower than it would have been when you were back here buying, but it's not going to be significant, and it's gonna be permanent. So this is really the kind of pros and cons of the market as we're seeing it. I'm not gonna tell a person when to make a move, but I am just gonna simply say, you've really got to factor in this equation, and then you've got to decide at what point in here are you going to be buying or selling, if that's your plan. And then what's that future going to look like? Are you going to have equity being built in the future? And is there going to be a point in time which you can refinance into a lower interest rate? Personally, I'd rather lock in a much lower sale price at a high rate. I've got to be able to afford the payment and be reasonably comfortable with it. But I just know that in a few years from now, 1, 2, 3, 4 years from now, I'm gonna refinance that, get it into a lower interest rate, a lower payment, I'll have some equity, probably roll off my PMI, and then that's gonna be a winning scenario. So I hope that helped you guys. That is what's going on in the Twin Cities real estate market. Go check out the channel. You'll find neighborhood tours, buying and selling tips, first-time buyers, sellers, everything you could want over on the channel. You'll find my information in the description down below, and I'll catch you next time.